What's good, everybody? If you clicked on this video, you probably want to find out how you could make money when the stock market goes down and if it tanks and there's a second wave of the coronavirus and everything goes back to what happened a couple months ago. If you're new to the channel, my name is Ethan Chase and I post videos every single day of me trading the stock market and weekly videos about personal finance, investing, and life. It's no surprise that today the stock market tanked and it was a crazy day. Pretty much everything sold off. There's a bunch of panic and fear in the markets, especially because of yesterday's Fed meeting where there was a pretty kind of negative and pessimistic outlook. There's fears of whether there's a second wave of the coronavirus and if, the world economy will shut down again. It's definitely a very risky stock market and investing environment to be in, but there's a couple ways you could still earn income throughout this time. And I'm going to go through them in today's video. The first way you could earn income is through trading, and there's two types of trading. There's day trading, which is what I do. That's when you buy and sell a stock or an option the very same trading day. You could either, buy it and go long, so buy at $5, sell at $10, or you could go short and sell at 10 and buy it back at 5. Day trading is super high risk, but there's also a super high reward, but it's very risky, and if you have no idea what you're doing, you're probably going to lose a lot of money. The other type of trading is swing trading, which I also do. This is more speculative, shorter time frame trades. It's not long-term investing, like, investing in an index fund and waiting a couple years. This is more any time from a couple days to a couple weeks to like even a month or two. And this is the same thing. You could either go short a stock or go long, and you're looking for kind of relatively quick price action in a short time frame. That's the first way, is trading, and this is probably the riskier of them all. So if you don't know what you're doing, this probably isn't the best way for you to position yourself in the stock market. The second thing you could do is just invest in stocks and kind of dollar cost average down on good stocks that pay a healthy dividend. Dollar cost averaging is essentially you keep adding to your position over time. So let's say you buy a stock at $10 and then in a couple months it's at $8. You could buy the same amount of shares at $8. So now your average kind of position basis is $9. So you keep lowering essentially your average price at which you bought the share. So it's easier to turn a profit when the stock rises a little bit. The benefit of this is that you're over time adding money to your stock portfolio, which allows for dividend collection and kind of compounding growth. What you could do is invest in good quality, high quality stocks that pay a good dividend, so you could collect quarterly or even monthly cash flows, which you can, reinvest back into the stock market. Now, there's always a risk that you lose money because the stock goes down in price, and the loss at which it goes down in price outweighs the gains from the dividends, and that's a very viable option, especially in a very volatile stock market. So you gotta weigh the quality of the stock against how much dividend it pays. And of course, the dividend is good because it acts as somewhat of a buffer against the price of that stock going down. The third way is by going short the market, and that is betting and placing a bet that you think the stock market will go down in value. You could essentially, let's say, buy SPY, which is kind of the ETF or fund that tracks the market. You could sell it for say $300 and then promise to buy it back at a later price, let's say at $290, and then profit that $10 difference. This is a very speculative kind of trade, especially because your downside and your risk is infinite. SPY and the market could keep going up and up and up forever, and your loss could keep going up and up forever. Whereas if you go long a stock and you bet that the price will go up, your upside, or your downside rather, is capped at 0. So the max you're willing to lose is your initial investment. There's a couple ways to bet against the market. The first option is just to short individual stocks by clicking the sell button, or you could actually buy put options, which I'll explain now. A put option is a type of option. It's a type of contract that allows you to sell 100 shares of the underlying stock at a certain strike price at a certain or by a certain expiration date. Many people trade options not to actually exercise their contract to actually buy or sell the 100 shares, but just to profit off the swing in prices. Options are super volatile and there's a bunch of literature on them. So if you're not too versed in options, I wouldn't recommend it because especially if you're buying a put, you're betting that the market will go short. And on top of that, you're dealing with options, which is pretty risky. But of course, with more risk comes a higher return. The second way is just to short individual stocks. So instead of buying, index funds that you think will rise over time, you could short index funds that you think will go down over time. And to do that, you use a brokerage that will allow you to short stocks like Webull or like Thinkorswim, TD Ameritrade, and you could essentially sell it and then buy it back at a lower price and net the difference in price as your profit. Again, the harms of going short a stock is that it's risky. We know that for kind of on average, the historical annual return of the market is around 7 to 10%, give or take. So betting that the stock price will go down is going against history. And in addition to that, your downside is infinite because the stock price could keep going up and up and up, and your losses could keep going up and up and up as well. The fourth way to make money or make cash flow, regardless of where the market goes, is by selling what's called covered calls or covered puts. This is a pretty in-depth topic, which I'll cover here briefly. If this video gets a lot of attention and likes, and you guys want me to make a more in detail video of covered calls and puts, I will. The process is you're essentially writing or creating a contract for someone else to have. If you're selling a covered call, you are betting that the stock price won't go above a certain price. And if it doesn't, then you could just collect the premium that you received initially and move on with your day. If the stock price goes and stays above that certain strike price, then you actually have to give away your 100 shares of that stock or give away the collateral that you put up. Conversely, if you're selling a covered put, you're betting that the stock price won't go below a certain price, and if it doesn't and the option expires worthless and not exercised, then you just collect a premium. So when you sell either a call or put, you basically net and collect a premium, which is yours forever, and you can do this every week, every month, bi-weekly, whatever you want, and it's just a good way to earn constant sort of passive income. The risk is you either have to sell 100 shares or buy 100 shares at a certain price, and that price might not be the actual market price that is currently trading at. I hope you enjoyed today's video. If you want me to go into detail on any of the 4 kind of strategies I explained today, comment down below which one, and I will for sure make another video on it. If you're new to the channel and you enjoyed it, please hit the like button. I do all this in my own free time, and I'm giving back to you because I learned about the stock market, trading, and investing primarily on YouTube, all for free, and I want to give back to you guys. So in return, all I ask is for you to like the video and hit the subscribe button, because for me, every new like and subscription is another step in my journey to financial freedom.